Behind the Ticker is brought to you by UX Wealth Partners. If you're a TAMP user and you're sick and tired of the legacy technology they are run on and you want more customization and flexibility, as well as a AI-driven model marketplace, UX Wealth Partners is your destination. On top of that, they have institutional trading. So if you are an ETF issuer or an SMA provider looking for outsourced institutional trading, UX Wealth can also be your destination. So check out uxwp.com to find out all the ways UX Wealth Partners can help grow and make your practice more efficient. Welcome to Behind the Ticker. Today we have Nancy Davis. She is the founder and CIO of Quadratic Capital. We are here to talk about their interest rate volatility and inflation hedge ETF, IVOL, ticker IVOL. IVOL was really designed to provide investors exposure to tips in the rates market, offering inflation protection and interest rate volatility hedging. As you can see, it's a bit of a mouthful and it's a very institutional feeling product. This is not a product generally easily available to retail investors. So Nancy and her team at Quadratic have wrapped this into an ETF for you. So I think you'll find this product very interesting as a complement to traditional fixed income or ag exposure. So without further ado, please welcome Miss Nancy Davis. Hey, Nancy, welcome to the show.
Thanks for having me.
So before we get started, I'd love for you to share your background and how you eventually decided and founded Quadratic Capital.
Well, before founding Quadratic, I was with Goldman Sachs for the majority of my career. I was there about 10 years, and I'm proud to say that I've been running Quadratic more than 10 years at this point. I founded the firm in 2013.
And so what made you kind of make that leap? I'm sure, everybody in our world would love to have that job at Goldman, right? And so you were there for 10 years. What made you kind of go that entrepreneurial route?
I think it is the American dream. I always just kind of wanted to start my own firm and just, sometimes you never know, like so many firms start and they don't make it. So I think I would definitely encourage all entrepreneurs out there to just go for it, right? It's sort of like you only live once, and it's been just the most amazing experience. But a lot of the things that you do when you start a firm, you've never done before in your life, so it's a huge learning opportunity, and also kind of knowing when something's not working and when to stop doing it, how to pivot.
Yeah, sometimes those are the hardest decisions to make because, you come up with a good idea and then it's hard to kind of pivot and move. But you guys have had a lot of success, and we'll talk about the success of particularly IVOL here later in the show. But before we, get too into business, I always like to ask, any hobbies? What do you like to do when you're not behind the desk?
Well, I'm a big sailor, so it's a very negative carry, high tail risk strategy, kind of hobby to have. But I did it growing up and just love it. How about you, Bradley? What's your fave?
Well, right now I'm a taxi driver for soccer practice. Is mostly what I've been spending my time on. But if I can get out on the golf course, that's and it's funny. I don't know what it is about ETF issuers or finance, but you're probably the sixth person on the show that has been a sailor.
Oh,
I know Katie Stockton's a big sailor. I forget who else I talked to that's really into boating, but it must be popular with the ETF space. So
yeah. It's a very serene, it's quiet, right? Some people like motorboating is kind of so different because you go more to like a destination, but it's loud. Sailing's just really chill. It's very quiet.
I've never tried it. It looks fun. It's probably something that has a major learning curve. Doesn't look like it's something that's super easy to do. So
it's about the journey, not the destination, because you don't really go very far or very fast.
Yeah, I could see. I don't know if I'd want to go too fast in one of those things, but let's talk about Quadratic Capital kind of holistically. You mentioned some pips. So did the firm start out to be an ETF issuer? Are there other things that you guys do for clients? Like holistically, can you talk about the firm?
Yeah, so we're a RIA, and initially when we started, we were managing separate accounts, and then we started a hedge fund as well. And then we got into ETFs in really, 2018 is kind of when I really was like looking to have a better, you always hear about the tax efficiencies of ETFs. And I was just like curious and wanted to learn more about the ETF wrapper and kind of how to use it. I almost saw it as like as a fin technology. And then it was just like, wow, this is just such a great package to use. And we can harvest all these tax efficiencies. And it's just I think, a great solution for clients, because in the bond side of the portfolio, there's really like everybody is just, short optionality because of the embedded short option in mortgages. If you think about it, like if you have a mortgage, you're along the option to prepay. So if somebody owns a financial mortgage in their bond portfolio, they're short options to homeowners. And I just thought it would be a really great way to give people choices so they're not only short fixed income volatility in their bond portfolio.
Well, yeah, let's talk about IVOL right now. It's your interest rate volatility and inflation hedge ETF. So like at a very high level, let's just talk about what that fund's trying to accomplish, and then we'll dive a little bit deeper into it.
Yeah, so it's trying to fix some of the problems and be more of a solution for investors to the ag index on its own. A lot of people have the ag because they want, they're not trying to take a view on the Fed or where interest rates are going to go. They just want core fixed income exposure. And the big problem with the ag is that over a quarter of it is mortgages, which are short optionality, as we just talked about. And then there's no inflation at all inside the ag. There's no inflation protected bonds. There's no exposure to the rate market. So we just thought this would be a good way for investors to access the rates market. And it's something that most people just can't do on their own. Most people have stocks and bonds in their financial portfolio, but the biggest asset class in the world is interest rates. So we really see it as an access vehicle.
So would you hold this kind of because my next question was kind of about the ag exposure, and same goes for tips. So like, is this going to encompass kind of broad exposure to both of those in a way, right? Like you'll get the inflation protection, you'll get the interest rate. Like, can you talk about why someone would want to use IVOL as either a replacement or kind of a supplement to those two? Because ag and tips, those two ETFs, AGG and TIPS, are like really heavily used. So can you just kind of talk about why someone would want to look at IVOL as either a substitute or a complement to the both of those?
Yeah, so we see it more as like a completion portfolio to the ag. So the ag has no tips inside of it. And then it only has, short optionality through the mortgages, which is about 26%. So a lot of people take their core holding the ag and then they add IVOL on top of it. So IVOL is 80% of the fund is tips, which are, type of treasury bond. They're treasury inflation protected securities. But the two problems that you have with tips by themselves is, number one, the only index used to reset inflation inside of tips is the consumer price index. That's just an index, right? Nobody in the equity world would use, the Russell or the NASDAQ or the Dow Jones and say, ta-da, I have the equity market. And, we keep hearing from Jay Powell, like even the Fed doesn't use just the CPI as its only measure of inflation out there. So it seems silly for investors to only use CPI, especially because so much of the basket is the owner-occupied rent. So it's a huge component, about a third is rent.
So let's talk about how this portfolio is constructed while we're on that. So we understand how, ag and tip are constructed. Like, so how are you constructing IVOL? What are people finding in as kind of general holdings inside the portfolio?
So the fund is pretty different because it accesses the rates market. Most investors can't do that on their own because it is a over-the-counter market. I like to compare it to mortgages. Prior to mortgages getting QSIP'd, before the savings and loan crisis, the whole mortgage market was OTC. So I see us QSIPing the rates market by giving access to interest rates. Tips are a pretty new market. It's just important for people to understand the Treasury only started issuing inflation protected bonds in the late 90s. the only index is CPI. And a lot of people will just say, okay, here's our core holding in the ag, and we're going to add IVOL on top of that to add exposure to tips and also exposure to inflation expectations outside of CPI.
So correlation, I was looking at your correlation matrix. It's extremely attractive. So if you're sitting down with, a portfolio manager that has an already diversified portfolio, like where are you recommending IVOL gets a seat? I mean, you could view it in a handful of different ways. I just was wondering, like, what is the best utilization of IVOL in your opinion?
So it usually sits in the fixed income side of the portfolio. A lot of people use it as a completion portfolio to the ag. So they'll take whatever they have exposed to the ag and they'll say, okay, maybe simple math, like 26% of the ag is mortgages. Mortgages are short options to homeowners. So we'll take, 26% and add IVOL to help reduce that short volatility exposure in our bond portfolio and also add inflation and inflation expectations outside of CPI. The people who have IVOL as a larger weight in their fixed income portfolio are usually the ones who are pretty bearish on credit. Very simply, if you have a stock portfolio and then you have a bond portfolio with a lot of corporate credit risk, let's just take, say you own Apple stock and Apple bonds, you really have the same corporate beta. And credit spreads right now are super, super tight. Like, let's see, I'm looking at my Bloomberg right now, and the investment grade 2-year CDX index is 22 basis points. So it's impossible to go to zero, right? Because it's got to have some spread. And so if you own a bond with credit risk, you want credit spreads to tighten. But when they're already at 22 basis points, there's not a lot of room to actually have appreciation. And credit spreads can widen, and they typically do when equities sell off because they are corporate beta, right? They're just a different part of the cap structure. And so I think the clients that have IVOL as a bigger weight in their fixed income portfolio are the ones that tend to be a little bit more concerned about credit spreads widening, or maybe if they want to take their corporate risk, they'd rather take the risk reward in equities and use IVOL as a potential carry trade instead of credit.
See, and you walked me right into my next question. So IVOL, you would want to, I'm assuming that in periods of equity risk off or the potential for equity risk off, you're going to be increasing your exposure to IVOL. Is that correct?
Yeah, it kind of depends. So IVOL doesn't have anything to do with equities inside of it, but it is long interest rate volatility. So volatility, when markets become stressed, volatility tends to increase, and we don't have the VIX. I'm very proud to say we have very, very low correlation to the VIX. We're not correlated at all, but it's another type of, in a risk-off environment, we can benefit from the Fed cutting rates more than what's already expected in the market. So kind of like March 2020, we had positive performance in March 2020 when tips alone were down. And that's because we can benefit from either Fed cuts or from rising interest rate volatility because we own options. So when you own an option, you're long vol. We happen to own interest rate vol, so it's just something else. And I think that goes back to your point, Bradley, about the correlation. It doesn't look like everything else, right? It's not another strategy that's plus or minus 25 basis points to a benchmark index. It's truly something different. So it's not always going to make money. Investing definitely involves risk, but it's something that gives you access to something that you probably don't already have inside your portfolio.
Yeah, I mean, the product's extremely unique. It's probably why you've had so much success in raising capital in it. And it feels very institutional quality in nature, right? A lot of the ETF plays are, as you know, kind of in this space, like indexy, and this has some flavor to it. With that underlying exposure, like how often are you reconstituting that portfolio? Are you on, a weekly or monthly cadence? Is it active, annual? Like how often are you making changes inside the holdings of the ETF?
Yeah, so we are an actively managed ETF, so we can make changes whenever we're fiduciaries for our shareholders. So whenever we think it's appropriate, I think we tend to take profits more when the options are making money and working. Like for instance, Silicon Valley Bank Week, IVOL was up 16% in a couple days. We did take profits. Like in hindsight, I wish we took more profits off the table, but we tend to profit take more because we're long options, the amount we can lose is defined on the options piece to the premium that we have at risk, the premium that we pay. And then there's never an obligation on the fund for more cash, unlike other linear derivatives. This is options, long options only. But when they work, we can have asymmetric amounts of potential upside. And so I think that's really the trick, is more about trying to monetize those moves and take advantage of those, but also keep the exposure as we see fit.
Got it.
Yeah.
So is IVOL also, can you use as an income play as well? Do you guys have a month, or do you have a distribution cadence? Is there yield in the portfolio?
Yeah. So the SEC is pretty particular about the word yield. So we talk about like the 30-day SEC yield, which you can see on the website. We have paid a 30 basis point monthly distribution for over 5 years. So sometimes TIPS ETFs, if you look at, various TIPS ETFs, they don't pay distributions at certain periods of time. We have, for over 5 years, every month paid at least 30 basis points. So it's something to look at if you're looking for monthly distributions. But I try to be careful about the word yield and income, because it's a distribution, and it's really a question of how that distribution gets taxed at the end of the year too. We try to be really, really greedy with every single basis point and be as tax efficient as possible. We even use a Bloomberg TIPS index inside of our ETF to do our treasury trading in kind. I'm curious, Bradley, if you've ever seen another ETF do that. I've never seen another one, but we've been able to do all of our treasury trading in kind. Whereas if we bought the treasuries directly, every time we sold them for a gain, treasuries are capital assets and they would generate capital gains.
Well, like I alluded to, 5 minutes ago, the institutional feel of this product and what you guys are doing is definitely a level above. It probably goes back to, your time at Goldman and also your time running funds. So, or a hedge fund, but yeah, it feels very well thought out and very institutional. If it's okay with you, I want to flip over to BNDD.
Yeah.
Which is your deflation ETF. Same question as IVOL. What is this ETF trying to accomplish holistically, kind of a big picture?
So a lot of people so BNDD is nominal treasuries. It's long duration, very long duration nominal treasuries, whereas IVOL uses inflation protected treasuries. So that's real yields versus BNDD it's sort of like people would own, TLT and TIP, right? They're not opposite. They're just different exposures to the treasury market. Our big issue is, we're not big fans of linear derivatives. So anything like a linear derivative is a future, a forward, a swap. It goes up $1, down $1. I like to think of it as almost like a credit card exposure, because you're not really paying for it. You're just paying like a little bit of margin. And I think part of the problem in the bond market is a lot of people use leverage. It's all over the place. So BNDD and IVOL do not use leverage in the sense that we're not borrowing money. We don't have margin calls because we don't have, everything is fully funded and paid for. But we do have asymmetry for when bonds move. So BNDD does well when either the Fed is hiking rates or when long dated yields are falling, meaning long dated treasuries are rallying. So it's had its benchmark is the long term treasury bond, and it's had tremendous outperformance during this very crazy period. There's no guarantee that it's going to continue to outperform as much as it has, but it also pays a 30 basis point monthly distribution at minimum. And then we've had higher distributions as well because of the gains that we've made from the options piece.
Yeah. So I think you just answered this. So what environment, well, let me ask it a different way. So is there a certain environment you want to own BNDD? And also, is that the flip side, the other environment or the opposite of that environment where you'd want to own IVOL? Are they complementary in any way?
Yeah, it's not one or the other. I know inflation and deflation sound kind of like they're mirror images of each other. They do different things. Somebody could be, the biggest, like say you have a ton of Mag 7 tech stocks, you're, super bulled up in that space. You might want to have IVOL there just in case, we have, more inflationary pressures, right? So just because you have, not everybody has like one view in a portfolio. The whole point of like the art of, portfolio diversification and asset allocation is to not have, everything go up and down together all at once, right? That's when your portfolio becomes correlated and when you have a problem, especially in sell-offs. So I think these are both tools for investors to, look at to say like, what are our needs? What are our goals? What are we, how are the tilts in the portfolio? How might we want to counteract this? In my, personal opinion, I think everybody should own IVOL, in my opinion, because most people are benchmarked to the ag, and the ag is only short options because of that, over 25% being mortgages. And the Fed has said they don't want to own mortgages long-term on their balance sheet. 35% of their balance sheet is mortgages. And I just feel like we live in a real world, right? No matter what industry you're in or what job you have, like you could be a school bus driver or a finance bro, like whatever your job is, you have some amount of life savings, right? And the goal at the end of the day is to make sure that when we get to retirement, we have enough income and enough money to maintain our lifestyle. And I think, Ronald Reagan said inflation is the thief in the night. And right now, inflation markets are priced really, really low. I'm just looking at my Bloomberg terminal, like the 2-year break even, just to pick a number, is 1.76. So the market is already pricing that inflation will go below that 2% target in the future. And so to me, I think it's just a great opportunity to say, look, interest rate vol is down tremendously since Silicon Valley Bank. Nothing has really fundamentally changed at all, right? All those same issues exist. If anything, we're kind of facing a bigger, fiscal situation, no matter who wins in November. Nobody is talking about reducing our debt, right? It's just a question of where we're going to spend money. So I think it's a great time to have, to help diversify the ag and have some exposure to inflation and inflation expectations in the future outside of CPI, because CPI is only calculated by the Bureau of Labor Statistics, and a third of that index is rent. And then I just don't like only being short volatility in my bond portfolio. Like it makes me uneasy at night. And I don't think a lot of people realize that mortgages, although they're a single CUSIP product, close your eyes. Homeowners along the option, if you own the financial mortgage, you are short options to homeowners. And whenever you're short options, you're short vol. It's not equity vol. It's not the VIX. It's actually fixed income vol. So I think it's appropriate for a lot of different people, but I think that's where, I'm a portfolio manager, not a financial advisor. And that's where you should talk to your financial advisor and see if it is appropriate for you.
Yeah. Thanks for that. Was super helpful. Staying on BNDD, how is this portfolio constructed? Like what are the holdings that you're going to generally find that are going to be different than IVOL?
Yeah, so it is different because it's still treasury bonds. So 80% of both funds are treasury bonds, but we use different types of treasuries. IVOL is inflation protected treasuries, sometimes called TIPS. And then BNDD is long-term nominal treasuries. So new reset to inflation. It's a really, really long end. So it's like super, super duration. So it's BND deflation or super extra long duration.
So we talked about this with IVOL, but again, you said you're not a financial advisor, but you know how portfolio management works. Are you slotting BNDD in again in your fixed income sleeve? Is this where you're putting it?
That's what I'm not a financial advisor and I don't construct client portfolios. I just manage I'm the PM for both of these funds. And so I think the trick is always like, where does it go? It does go in fixed income. How do you use it? How do you size it? Those are always kind of the tricky questions. Once you get past the appropriateness, that fund, it kind of depends like how much duration people want. But I'd say with IVOL, I think you can have a larger allocation, in my opinion, because inflation expectations are so low and it's not in the ag. Whereas the ag, a big component of it is treasuries. So you just have to be careful that you're not taking too much treasury duration.
Got it. Well, Nancy, I thank you very much for explaining all of this to me. It's definitely complex, and looking at it, it definitely, you guys have had a ton of success in IVOL. That fund, if you've only launched it in 2018, has done very well in terms of gathering assets, and it's had some very good years. So congratulations on that. Before I let you go, though, where can people learn more about both of these funds? Where can people learn more about you and Quadratic Capital?
Well, both funds have a website. So it's either IVOLETF.com or BNDDETF.com, or you can also look at the KFA page to get more information on the funds. And I think, we do try to, it is different, right? It is something, it's not like another fund that's doing the same old stocks or, cutting up an index. So it's something truly different. And it definitely takes, I think, more intellectual curiosity and more time to learn about it and see if it's something appropriate. But we try to do our best with our materials to really describe, in a symmetric way, what the risks are and what the potential rewards are.
Yeah, I was actually on the website. There's some white papers on there as well as some presentations on there. I think people, after listening to this, should take the time to check out, because it does walk you through kind of in a very systematic way, like who you are, what the product is, where it works, where it might not work, and what environments it is favorable. And so you guys have done a really good job, I think, in terms of investor education on what can be, a more complex area that I would say most finance people are focused on equities or just fixed income as a whole, where this is, diving more into, interest rates and other things, which I think confuses people sometimes. So go check out their website to find out or to read those white papers and to also go through those presentations, because they were helpful for me when I was trying to learn about everything you guys do. But again, Nancy, I thank you so much for your time and appreciate you being here with me today.
Thanks for having me on. It's really been a pleasure.